Extraordinary. All right, good morning, everyone. Let's kick it off here. Sorry about the late start. We had a lot of earnings numbers out this morning. All right, U.S. session last night saw a bit of a sell-off, really led by the retailers. We had a slew of retailers come out last night with earnings that were worse than expectations. Particularly on the guidance, some of the numbers were a bit soft. We had Dick's Sporting Goods, Urban Outfitters, and TJ Maxx that all kind of fell on the retail space there, kind of helping to lead that sell-off. We also saw Caterpillar that has 3-month rolling sales numbers that came out were definitely soft, and especially soft in Asia. Numbers that they were down about 20% from 2012. So really showing a softening in demand out of Asia, which we would expect at the moment. We also had some statements last night out of Philly Fed President Charles Plosser, basically saying that QE3 might end this year and that rates could be increased earlier than generally anticipated. One of the other Fed members also spoke last night, and he was definitely more dovish, but I think this just kind of amplified the bias that we had already seen in the day, the sell bias that we'd already seen from earlier in the morning. So, all in all, a negative session out of the States. Didn't really get ugly or messy, over there, but definitely continuing on the sell pressure that we've seen in some of the NASDAQ listed stocks and the Russell stocks. All right, in Asia this morning, we had a bit of a mixed bag. Shanghai was actually up, and Hang Seng's managed to kind of eke out above flat line in the afternoon, but no real selling. I mean, the Nikkei was down a little bit. I'm actually surprised the Nikkei is not down more than it is, because we continue to see strengthening in the yen. The yen's actually below trend support, or I suppose this should be resistance, because the yen's actually strengthening versus the dollar, and I think that's going to be really, really important going forward. Some people were expecting the BOJ to come in and maybe throw a little bit more stimulus at it today. It didn't happen. We also in the Asian region, we also saw a little bit of further weakness in some of the mining stocks. We had some negative comments coming out of iron ore again. BHP Billiton making some negative comments there, and really continuing the slide in iron ore prices. The supply is really kind of going through the roof right now on the iron ore side, so that's that prediction that we've seen from a lot of the investment banks there is starting to come to fruition. All right. This is a chart here showing the actual price of the Aussie relative to earnings. The one on the left since 2009, the one on the right since 2012, and you can really just see there. I mean, it's absolutely incredible. The continued divergence that we see between the actual share price and the underlying earnings, essentially meaning that the ascent that we've seen in our market has not so much been buoyed by earnings or fundamentals. It's been more by maybe just a shortage of available stocks to the likes of the PIC and the Allen Greys and Coronation of the world. So we continue to see the market driving higher. I have a personal theory that there's just been such a lack of IPOs that have happened here locally, and unfortunately so many of the funds are mandated to only invest here locally. And they have to put it to work, and that's kind of been the result. So, our market's starting to look very quite expensive, maybe relative to earnings at the moment. So just keep that in mind as an interesting chart there. All right, this morning we had a lot of corporate action out. This morning we had the sales numbers out of SPAR. We had headline earnings per share, which came in a bit light at 348 versus expectations at 355. We also had a bit of a miss on the revenue number at 25 0.83 billion. Expectations were for almost for about 900 million more than that. And then we came in line on the divvy per share there, but definitely a little bit soft out of SPAR. Definitely said, they're in a challenging environment at the moment, so not great guidance either. Out of Tiger Brands, we saw them come in line with the recent guidance that we saw from their trading statement. Revenue was a bit softer than expected, but they did come in also with a little bit of a beat on the divvy there by 19 cents at 3.29 versus 3.10 expected. MediClinic came in at the top end of the expectations on recent guidance from the trading statement. Headline earnings per share at 3 Rand 77. Revenues also a reasonable beat, about 500 million. At 30.49 billion, but divvy per share came in a little bit light. I want to say that there was talk before about a special div, but I don't know that there was anything in it this morning. So yeah, you'll have to keep your eyes out for that. And then later in the States, we got Lowe's and Target with earnings. All right. The market data today, we had Japanese trade balance, which is a bit softer than expected. We also have CPI numbers here locally at 10 o'clock. We've got the ECB current account numbers coming at 10. We've got retail sales in the UK. We've got the BOE, which is going to release minutes from its May meeting as well. Later in the States, we've got mortgage apps. Then in Europe, we've got consumer confidence. And then we've got the Fed going to release minutes from its April FOMC meeting later tonight and the U.S. session. All right, let's get into the maps. Okay, first thing I'll have a look at here is, no, wrong chart. Okay, there's the US dollar yen. We had been looking at this chart for a while. Let's back it up a little bit. 2 year there we go. Okay, so now you can kind of see the length of consolidation that we had. We had this sort of wedge pattern that we had that built up for quite a long period of time. Back in 2013, we finally broke out to the upside and managed to hold that level. We've kind of had the same sort of thing running now for, again, the last 6 months or so. And the bottom end of this pattern, okay, so I'm going to take us forward here. You can see there the bottom end of this pattern really not as steep, I guess, it's looking more of a descending triangle here, but we've definitely, without question, we've dropped out the bottom here. We've also dropped below the 200-day moving average. As we speak, actually, we've just dropped the 101 level and really starting to gather some downward momentum on this trade. I really think that this is much more important than the market's kind of paying attention to at the moment. And I think as we move down to the 100 level and potentially if we drop the 100 level, I think that could really be an instigator for some higher volatility, potentially a little bit of unwind in risk assets. Remember, I think everybody and their brother is probably been in this carry trade for a long time, especially when it kind of just gets blasé like this and starts moving out to the right. The volatility in the actual currency has been so low for so long now. Guys just kind of leave it because they're earning a couple % in yield just on the carry. And when this happens, guys can be kind of slow to get out, but when they do start to get out, it can get ugly and ugly fast. So let's watch today. We've just dropped 101. If we continue to push lower from 101, I think it's bearish for equity markets, and you could start to see a bit of a slight bit of risk unwind on the back of that. So we'll watch that going forward. All right, Impalas, speaking of long-term little wedge patterns, this one's been about the longest I've probably ever friggin' seen. This has been running for from, call it October last year. We've been in this same pattern. This, in terms of the levels here, line up beautifully. You can see here we've got 1, 2, 3, 4, 5. Call it 6 because the bottom of the candle there, 7, 8 touches on the bottom of this line. I think it's very clearly defined that 115 was support, which we obviously dropped. We dropped yesterday. We traded to a low of close to 113. We did close a little bit higher. There was also some news at the end of the day. They have a 3-day dispute process now that where they're going to have a mediator for these platinum companies, and that's probably a bit of a short-term positive, but nevertheless we've really dropped out the bottom here, and the rest of the mining complex is also looking really soft. We'll show some of the others there, but this one's really important. I'm personally of the opinion that these are the next gold shares, and that they're just going to continue to dwindle into non-existence over time. So just keep that in mind. I think it's 115 is a critical level. If we can't regain it today on that bullish news, I think it's quite bearish. All right, we're looking at ARIs here. ARIs kind of going into the further theme. This thing definitely dropped longer term support recently here. We dropped out in April, and then we came back up and we tested it perfectly, and we failed it again. We're pushing lower out of a little continuation pattern here below, call it 193. I really think that this thing's probably got a little bit more downside in it. The iron ore stocks in particularly have been really soft of late. Anyway, the pattern here should set us up for probably about a 12 rand down move below 193. So we'll call it probably closer to 180, which actually lines up relatively nicely to this little consolidation, the bottom of this little consolidation support. And if that drops, it's going to get really ugly for ARI. So watch it going forward. I think that this one could be a bit of an opportunity. Also, let's look at Kumba here, which really is coming down to test multi-year lows. I think this is 2-year lows, if I'm not mistaken. We're going to look at the closing price. So forget the wick. Closing lows are, let's see, no, I'm the wrong number there. Closing lows are at 52.40. So call it 352.40, 352.50, somewhere in that neighborhood. We did get down there and basically test that yesterday. If we can get below that and push below that, I think it's got a lot of room left on the downside. And don't sit there and try to catch a falling knife on this one. I know it's tempting. It pays a big divvy yield, but remember, if the iron ore price falls another 10 or 15% from here, the earnings are probably going to drop by 30 or 40%. The divvy yield's going to go through the floor. So just keep that in mind. We dropped 352 today, and I think 350 just to be safe, because that was where we really wicked down to. I think that this one can definitely get ugly. All right, last one we're going to show is CFR, and CFR's had also an incredibly long consolidation pattern, and of the recent trend resistance, we definitely broke out of that as of yesterday. What I probably would only really be comfortable jumping in on this thing from is if we actually made new closing highs, and the closing high is, let's see here, the closing high is at 109.37, which is not far. We did get up to more or less exactly that level yesterday. So if you see that level there, kind of showing the old-time closing highs and CFR, if we can get above that level, I think we've really got room to the upside, and it could kind of really catch a lot of people off guard, from the recent earnings that have come out. And that's it for today, guys. Thanks a lot.